Hi guys, and welcome to another week ahead video. Now in this week's video we're going to be focusing on the Kiwi dollar and more specifically on the employment data, quarterly employment data that we have coming out for New Zealand in this upcoming week. Now the reason why we're focusing on the Kiwi dollar, we have recently changed our fundamental bias for the Kiwi dollar to a bullish bias. The reason for that is an improvement in the overall domestic economy, as well as a favorable outlook for monetary policy in terms of the bank going on hold in November last year, and now the market pricing out any possibility of a rate cut for the rest of 2020, currently sitting at only 25% probability for any cut throughout the rest of the year. Now, fundamentally speaking, we are bullish on the currency. But most recently in this last 2 weeks, we've seen a lot of downside in the Kiwi dollar, along with the Aussie dollar and the Canadian dollar, as the risks about the contagion for the coronavirus has really gripped the markets. We've seen a lot of risk of sentiment in play. For that reason, the short-term sentiment has seen the Kiwi dollar really tank in the short term, and I think that provides us with an opportunity to buy back the Kiwi dollar at a later stage. Now, obviously, this week's main risk event for the Kiwi dollar to consider would be further fears about the coronavirus. But if we can see those fears dissipate and we get a positive reading on the employment data, I think that creates us with a very interesting opportunity to take a more medium-term trade on the Kiwi dollar in this week. Obviously, we'll need to wait and see what the data shows us and what the risk sentiment tells us. But let's jump into the data now, see exactly how we're preparing for this event and how we can possibly trade it as well. Okay, then looking at the baseline for the Kiwi dollar. Now, we've recently changed our fundamental bias on the Kiwi dollar to bullish, and the reasons for this is firstly a drastic change or marked improvement in the overall domestic outlook for New Zealand, as well as the reduction in the market's overall expectations for further rate cuts by the RBNZ in 2020. In terms of the economic or domestic data, we had Q3 GDP surprise to the upside, with the production approach quarter-over-quarter GDP coming in at 0.7% versus expectations of 0.6% and a prior of 0.5%. Now, the jump was even more impressive because there was a noticeable downward revision to that prior number from 0.5% to 0.1%. Similarly, in terms of the annual average GDP year over year, that beat the market's maximum expectation of 2.5% with a print of 2.7%, and the headline GDP came in slightly softer than expected at 2.3% versus consensus of 2.4%. Now, overall, the outlook for GDP is looking more positive as the downside risks has moderated, and with the expectations of substantial fiscal stimulus resulting from big infrastructure spending plans from the New Zealand government. Now, next up, we also have inflation. Now, inflation for Q4 also surprised to the upside, with quarter-over-quarter CPI coming in at 0.5% versus expectations of 0.4%, and CPI year-over-year printing higher at 1.9% versus consensus of 1.8%. Now, it's important to note that the biggest reason for that jump in inflation, especially that quarterly number, was due to transitory factors such as food and fuel over the festive period, which has the potential to unwind in later quarters. However, it's important to remember also that Westpac Investment Bank expects that inflation trend to continue higher throughout 2020 and also exceed that 2% midpoint target from the RBNZ. Following that Q4 CPI number, the market has significantly dropped their rate cut probabilities down to just 5% for the RBNZ's February meeting and down to a low of 25% for the remainder of 2020. In terms of fundamentals, growth currently is tracking around trend. We have inflation that has returned very close to target, and we have the unemployment rate sitting at 4.2%. That still points to a very tight labor market. For this reason, we have investment banks like ANZ that expects the RBNZ to stay on hold for the remainder of 2020, as the data gives the bank some breathing room to assess economic conditions before making their next move. Now, in the short term, however, the prior 2 weeks has seen some considerable amount of downside for the Kiwi dollar as well as the Aussie dollar and the Canadian dollar due to the contagion fears regarding the outbreak and continued spread of the lethal coronavirus. Now, the Kiwi and Aussie dollar are usually traded as proxies for overall risk sentiment, especially in matters concerning their biggest trading partner, which is China. So any continued risk of flows will keep the antipodean currencies pressured in the short term, and is something just to keep in mind. Then looking at the baseline for the upcoming risk events. Now, the main events that we'll be looking out for the Kiwi dollar for this week will be Q4 jobs report, as well as the Q4 inflation expectations that is scheduled for Thursday, jobs report scheduled for Tuesday. Now, even though these two data points should not be really enough to necessarily change the RBNZ's mind regarding monetary policy. There are still very important considerations for the RBNZ, and they could create some short-term trading opportunities if we see big enough or significant surprise deviations. Now, the markets are expecting the unemployment rate to remain unchanged at 4.2%, and for job growth to tick up to 0.3% from 0.2%. Now, inflation expectations, markets are looking for a slight increase from the prior of 1.8% to 1.9%. Now, a very important point for us to consider for the upcoming risk events this week will be the recent outbreak of the coronavirus. Now, the Kiwi dollar did see considerable downside in the past 2 weeks as the overall risk off tone sent commodity-based currencies like the RZ, the Kiwi, and the CAD lower across the board. And as it specifically relates back to New Zealand, some analysts have argued that the selling in the Kiwi dollar might be a little bit overdone, given that the lethal SARS virus that we saw in 2003 only saw a very small 0.1% reduction in total GDP for New Zealand. However, Westpac warns that judging the potential impact that the coronavirus might have on the New Zealand growth purely based on the SARS virus and the SARS impact is not really comparing apples with apples. The examples they gave was that when the SARS virus hit in 2003, only 5% of New Zealand's exports went to China. Currently, that number sits at 28%, and total exports to Asia, which has been affected a lot by the virus, alone is sitting at 48%. Thus, if the virus continues to plague China's economy for a longer period than we had with the SARS virus, that could have a much larger impact on the economy, and is definitely something that we need to keep an eye on, especially since we have that bullish bias on the Kiwi dollar. Now, looking at some possible sentiment shifts this week, in terms of the dovish sentiment shifts, the important point to keep in mind when it comes to dovish sentiment shifts is that it will take a lot more than just a miss in quarterly employment data or to inflation expectations to drastically shift the market's rate cut probabilities. Thus, if we trade the jobs report and the inflation expectations, there will be more short-term trading opportunities, as a very big enough deviation to the downside in either of those two economic data points could see further short-term downside in the Kiwi dollar. Now, risk assets did see some reprieve on Thursday evening when the WHO said that they are confident that China's efforts will reverse the tide of the virus. However, until then, the total amount of open cases has already reached almost 15,000. If we just quickly pop this graphic on the screen, we can see we're almost hitting 15,000, and unfortunately the death toll continues to rise, currently sitting at 305, which is a very significant jump. So that means that the worries about this virus will be far from over, especially as we see the market open this week. Thus, the highest conviction trading opportunity on the dovish side for the Kiwi dollar would be a significant miss in both the jobs report and the CPI expectations, and that will be accompanied with an overall risk off tone due to further contagion fears and escalations in the threat of the economic risks resulting from the coronavirus. Okay, and then turning to hawkish sentiment shifts now, something interesting to take note of was the latest CFTC data that was updated on Tuesday, 28 January. And that saw that the Kiwi dollar was still in a net long territory, with the market increasing their net long exposure. Now, this was quite significant when we compare this to something like the Australian dollar that saw markets increase short positions by over 8,000. Now, even though we did see a big sell-off across the board in the commodity-based currencies like the RZ, the Kiwi, and the CAD, the negative impact was much less seen on the Kiwi dollar when we compare to something like the Australian dollar, even the CAD. Now, this might be due to the market still seeing the overall domestic and monetary policy outlook for New Zealand remaining in positive territory, despite the recent threats of the virus. And it's important to remember that at present, the markets are widely expecting the RBNZ to abandon its very strong easing bias at their next meeting, by implying that they expect that the OCR to remain low for some time, but that they don't see the odds of a cut at 50-50 in the near future anymore. Now, we will need to keep a very close eye on the coronavirus and how that affects the global outlook, as that will play a much bigger role in countries like Australia as well as New Zealand. But for now, at least, it doesn't seem that the virus has affected the market's overall rate cut probabilities for the RBNZ. Now, on the back of that more positive outlook for the New Zealand economy, as well as monetary policy, the highest conviction trading opportunity on the hawkish side this week would be a significant beat in both the jobs report and the CPI expectations, accompanied by an overall risk on tone if the markets reduce their contagion fears regarding the coronavirus. Now, how we can look to trade the Kiwi dollar this week in the case of a dovish sentiment shift. due to a miss in the data as well as further risk of tones, we could look to pair the Kiwi dollar against something like the yen or the Swiss franc, which is classic safe haven currencies, which has remained well supported in the last week due to the increased contagion fears from the coronavirus. Alternatively, though, if the risk tones are more mixed during the week, we could look to pair the Kiwi dollar against something like the pound, which was well supported last week after the BOE surprise hold rate decision. And also just keep a very close eye on the latest trade deal negotiations between the EU and the UK, as that can affect the pound in the short term. Then in the case of a hawkish sentiment shift due to a beat in the data with the jobs report and the inflation expectations, as well as an improvement in the market's overall risk tone from a risk off to a risk on tone, we could look to pair the Kiwi dollar against something like the yen and the Swiss again, which should be pressured if we do see a very firm risk on sentiment in the week. Alternatively, though, again, if the risk tones are more mixed, we could look to pair the Kiwi dollar against the CAD, which was pressured in the last 2 weeks due to the dovish shift and tilt made by the BOC, as well as a massive drop in oil prices and obviously that overall negative risk tones that we had in the market. Now, it's important to remember, guys, that these recommendations are based on the current fundamental bias for these currencies at the time of writing and can obviously change throughout the week. So make sure to reevaluate whether the short-term sentiment is still valid for these currencies before you take any trades. Now, these type of sentiment shifts are valid for trading phase 1 trades. Now, if you want to learn how phase 1 trades work, you can check out our news trading strategy playlist on our YouTube channel, where we post weekly examples of how these trades play out. Now, after a phase 1 move, we can also look for potential phase 2 pullbacks of that initial move. Now, we post updates on these moves inside our tradable sentiment shifts reports on a daily basis inside the Forex Source terminal under the Market Insights tab. And you can also see each day which sentiment shifts are still in play and which ones are still valid for trading any phase 2 pullbacks. You can also learn more about them, how they work during our live analysis webinars each day inside the Forex Source terminal.